I have a passion for pension because it's a really important topic for everyone. It's about social infrastructure. It's about making people have a better situation, a good life after full-time work. And there's a lot of interesting topic in pensions, particularly from an expert perspective. So we invite a lot of interesting guests to talk about their area of expertise. And today we invited Zvi Bodie from Boston University. He has done a lot of work in the area of life cycle investing, and he also challenged the time diversification part. So we're going to discuss that with him today. And so Zvi, I wish you welcome to Pioneering Pension, and I'm looking forward to our conversation.
Same here, Stefan. Let me point out that on my side of the Atlantic, it's good morning rather than good afternoon.
Yeah, and what we didn't tell people is the sunshine in Boston. That's why you're hiding in your basement. Otherwise, we wouldn't see you.
Right, exactly. That's my basement that you see.
So in the previous webinar, we had a guest. It was Don Ezra. And he said to you, Zvi, that he really liked what you're writing. He thinks it's really good. It's sticking together. And he finds it really, really interesting. And we have to keep in mind what Don said as well, that when he invests his own money, and Don, he is enjoying life after full-time work. And he said he has 75% of his financial savings in stocks. And his question to you, Zvi, was, why are you so risk averse?
Well, I have always been risk averse. I do invest somewhat in stocks, but always with downside protection, either in the form of a put option or securities that are structured so that they give you at least your own money back and have the upside of the stock market.
Thank you, Zvi. And my first question to you is around life cycle investing. I know you spent a lot of time developing the theories together with Merton and others on what we call modern portfolio theory. And a lot of that is also used today when we design investment strategies for DC, life cycle investing. Can you tell us a bit of the background, how you ended up there and who you worked with and what inspired you?
Yes, so my graduate studies in economics were at MIT at a time when MIT had intellectual leadership in the area of life cycle economics. Franco Modigliani, who got a Nobel Prize in economics for his work on life cycle consumption, was one of my teachers. Even the great Paul Samuelson, who is considered probably the greatest economist of the 20th century, his earliest work and throughout his career, one of his major interests was how people should save and invest over their lifetime.
So you were talking about the time with Merton and others, and Friedman and others thinking about the life cycle.
Yeah, we mentioned Milton Friedman, but Milton Friedman, another Nobel Prize winner who did a lot of work on life cycle consumption. So it is a central issue in the history of economics, certainly in the theory. But the new stuff that Merton and I worked on, and Merton before me, but I came in as a doctoral student when Merton was a new assistant professor at MIT, and we started working together. And that is incorporating risk, and in particular, the risk of human capital. In other words, a person's ability to earn a living. So what Merton and I contributed to the theoretical literature and also the applied literature was how does the risk of your profession, for example, affect the way you should invest for retirement?
So see, in that perspective, you could say if you're like an entrepreneur or a civil servant, that would sort of impact how you would invest.
Yeah, so if let's take an extreme example. My son-in-law makes his living from the stock market. He's essentially a hedge fund investor. So even without him investing any of his own money in the stock market, his earnings, his human capital is very much tied to the performance of the stock market. So in his retirement portfolio, he should take a very conservative position. Nothing in stocks. In fact, if anything, he should be buying put options, which is insurance against the downside of the stock market.
So Zvi, I talked a little bit about time diversification. So I sort of built it up so you can launch your thinking about it. So
with that, yeah. So there is a fundamental fallacy underlying much of the practical advice and practice of pension funds and individuals investing for their own retirement. And that is the notion that you can invest in stocks. The stock market, you put everything into the stock market. It'll go up, it'll go down, but over the long run, it's going to outperform everything else, certainly outperform bonds. And the uncertainty, it almost disappears. That notion is called time diversification, and it is based on a fallacy. It is not the case that the ups and downs balance out over time. And even though it has a great deal of intuitive appeal, it's a fallacy. And I came up with a way of demonstrating that it's a fallacy using the theory of option pricing. But long before that, Paul Samuelson, the great economist, who was also one of my mentors at MIT, had demonstrated that it was a fallacy, and that in fact, no matter what your time horizon is, it should not have any material impact on how much you invest in stocks.
So Zvi, basically what people say, in the long run, stock will always outperform, so don't worry, there's no risk investing in stocks. And when you make examples out of, can you make some example and explain why this is?
Yeah, well, the bottom line, the point is the following. It is true that because stocks, well, first of all, let me point out a simple way to see that it has to be a fallacy. And that is, we all believe that stocks, investing in stocks offers a risk premium. Now, if it were true that the risk goes away in the long run, then the risk premium would have to go away. Because why would there be a risk premium if the risk goes away? Well, the answer is the risk doesn't go away. And the way to see that is, as your time horizon is higher and higher, the longer your time horizon, it is true that the probability of earning less than you would on risk-free bonds, that probability goes down. So in that sense, it becomes less risky. But the tail risk, the likelihood that there's going to be a really big loss, also increases. Okay, we call that the tail risk of the probability distribution. In practice, you could see that what happened, for example, to the US stock market in the 1970s, you had more than a decade of, on balance, negative returns. In Japan, you've had 30 years of poor stock market performance, earning less than bonds. So that tail risk cannot be ignored. And one way to see it is if you were to buy a put option, which is insurance against downside risk, the cost of that that insurance is actually an increasing function of the length of your time horizon. So it costs you more to insure against downside risk in the long run than in the short run. Now that's a little wonky. I don't know if everyone will understand that point, but suffice it to say that it convinces just about all the academics that I know who teach finance. Practitioners, no. They tend to want to believe that there's magic. It's wishful thinking, okay? As long as you have a long time horizon, you don't have to worry about stock market risk. Wrong. You do.
Thank you for that insight, Zvi. And if you're looking at what we do in the industry, I think most life cycle says you can have a lot of equity when you're young, and when you're getting older, you should have a safer investment. So it's not because of the stock market. I say the risk in the stock market is more like your human capital is pretty big when you're young and quite uncertain. So you could say we're right of the wrong reasons.
Yes,
correct?
Yeah. The correct reasoning behind, see, I believe that it is true in general that young people should be investing more in stocks as a percentage of their retirement portfolio. But the reason for that is their major asset when they're young is their human capital, is their earning power over their lifetime. The amount invested, the amount of their total wealth invested in securities is quite small for most people. Whereas when you're older, your investment portfolio is a much larger fraction of your total wealth, and you have much less human capital. So as a fraction of your total wealth, you could be investing the same fraction in equities over your life cycle. It just, because your portfolio is a changing fraction of the total, the fraction invested in equities is higher when you're young. I don't know if the viewers and listeners can follow all that, but the basic point is the amount you have invested in your retirement portfolio is small when you're young. Most of your wealth is your future earning power, and the portfolio is much larger as you approach retirement.
Zvi, while you were relocating from the basement to the third floor, I start to talk about my time when I moved to Holland and the sort of discussions around the Campbell-Visera model of time diversification of stocks. And I know that you were arriving, or you were in Netherlands roughly around the same time. And I just was intriguing to hear how people reacted on your thinking, academics and practitioners. Were you able to convince some practitioners?
Yes, well, the most important practitioner who I convinced was Jan Snippe, who was in charge of the pension plans for what's the big electronics company?
Philips.
And he actually tried to implement my suggestions, and it had quite an influence. But he also arranged for me to speak with the experts in the field in the Netherlands, people at ABP, for example, and a number of them saw the light, shall we say, and understood the argument and changed their thinking. But it's, you know, when someone has spent their entire career believing in something, even if it's false, they're very reluctant to change their beliefs. So, and most of the experts in the pension area are trained as actuaries. And the actuaries, with some very notable exceptions, believed very firmly in the notion of time diversification. So we have to make a distinction between financial economists and actuaries. The actuaries being the ones who were in charge of the practical aspects of pensions. So that argument still goes on. I mean, I'd say most actuaries still, even pension actuaries still don't get it. And it's not just in the Netherlands, it's in the UK, it's in the US.
Zvi, I would say it's a very good comment on this, because the big collective DC debate, which we see a lot of in the UK these days, this actually goes back to, do you believe in time diversification? Yes, then collective DC might be a good idea. If you don't, you should think in terms of a life cycle for the individual.
Right.
Zvi, you wrote a book which called Worry-Free Investing. I love the title, and I wish my investments were as worry-free. So I was thinking, in that book, if you're thinking more like, we're not a pension scheme, but as individuals investing for our retirement, what should you think of? What are your key recommendations to someone listening into this?
Right. So the fundamental idea there was, what prompted me to write the book was that it became, in the late 90s, the US government started issuing long-term inflation-protected bonds, which for the first time made it possible to invest for the long run in safe assets, because conventional bonds without inflation protection are almost as risky as stocks in the long run. But once it became possible for individuals and pension funds to invest in an inflation-proof safe asset for the long term, things changed. And I tried to explain that a sensible way to go about planning for the long term would, and this is the notion of worry-free investing, is to do a plan that took virtually no risk. Figure out how much you would have to save in order to smooth your standard of living over your lifetime. And you might not like the results you get with investing in safe assets, because the return is low compared to the potential return on investing in stocks, but it's safe. And then you ask yourself, all right, so when can I afford to retire? And it may be at a later age, like 70, 75 instead of 60 or 65. And then you say, all right, well, maybe I'm willing to take some risk. Then you have to bear in mind that the outcome could be worse, not just better, but it could also be worse. And you have to be prepared for that. So it's a different way. Contrast that with what the conventional advice that is given, which is, don't worry about risk in the long run because of the stock market. Don't worry about it because it goes away. No, it doesn't.
Yeah, and I was thinking, I want to go back to something you talked about earlier about, who you are and what your sort of career prospects are, how that also influences your
Well,
savings.
that's a major determinant.
Yeah. So
For
actually,
for most people.
yeah. So actually what you're saying is having a sort of one size fits all is actually quite difficult. You should think of this as almost a personal, very personalized decision.
Yes, that's true, although it is kind of a rationale for having pension funds that are organized by trade or industry, right? Because then you could say, well, anybody who works in, I don't know, as university professors and have tenure can take a lot more stock market risk, but people who work for hedge funds or in the industry that's related to stock returns, not so, you know. So it doesn't necessarily, it does lead to differentiation in the advice that you would give.
Yeah. And I was wondering, when we're thinking about what you should do in retirement, it is, how you say, everybody have a different view on doing it. So I think you have a strong view. And what they typically say is that children, they don't do what they say, they do what you do. So I'm going to ask you, what do you do when putting together your investment? What's your approach?
Well, my approach is very different. I view the notion of being retired full-time, playing golf or playing cards, or I don't know, whatever you do, you know, when past a certain age, that to me is death. I view retirement in that sense as the R word, to be avoided at all costs. So while I no longer teach at Boston University, and I'm 78 years old, I'm as busy as I ever was doing things related to finance. I am interested in promoting financial literacy, actively engaged. You will not find me on the golf course, except to take a walk on a sunny day. And I think I'm not alone in that. To go from full-time employment to full-time, let's call it leisure, a lot of people find it depressing way to spend their old age.
But I was thinking more like, you know, whatever rocks your boat, so to say, in how you spend your time. But I was more thinking about your portfolio. How do you look at your assets? How do you sort of put it together?
So my attitude is the essentials, you know, think of essentials versus non-essential items in your budget. For essentials, I have that fully covered by safe assets. And that means inflation protected bonds. You know, in the United States, we have savings bonds that are fully linked to the consumer price index. You used to have them in the UK, and then the UK Treasury stopped issuing those special savings accounts. But they're the best thing. And I've got, you know, over the years, I have tucked away a fair amount of money in that form of, they're called I bonds in the United States. So that's safe. And other inflation protected US Treasury bonds. We don't have pension plans that are linked to the consumer price index. In the UK, you do. In Netherlands, you don't. So it depends very much what the available securities are. It depends on the state-run system, Social Security in the United States. So
Yeah.
it's hard to give, but the basic idea is set down a base of reliable income that's inflation proof and is not subject to stock market risk to cover your essentials. And then if you want to take risk, you know, the way I put it to my kids is it's their money, you know, that's what they're going to inherit. So I'm willing to take risk with that money.
Yeah, they have a long horizon until
Yeah,
they're going to need it.
Horizon.
I was wondering if you, it's easy to think for yourself, but assuming now we took out the magic wand and I waved it and make you the CIO of a DC pension scheme, what would you, how would you invest the members' money then?
Well, I would give them some choice, first of all. And so it would be, I'd try and educate them about worry-free investing. They'd all get a free copy of my book, Worry-Free Investing. And the basic choice that they would have to make is how much do they want in safe assets where they know what the income stream will be in the future versus the amount to put at risk primarily in the stock market. They wouldn't have to manage it themselves, but they would have to make that decision. And the way I would guide them in making that decision is whatever you consider your essential expenses, cover that with safe. And it may very well be that there's nothing left to put at risk.
Yeah. So with that, I think it would be nice to hear questions from the audience to Zvi. And I know a lot of you probably have questions around the time diversification, probably what are the consequences and what are the lessons learned. So I have a question from John Ralph here, which says, hello, Zvi. Do you have do you want to give the example of Paul Samuelson's big hat and picking out possible returns and putting back everything you have pulled out? Thanks.
Well, John Ralph, who is a good friend of mine and is an important figure in the history of pensions in the UK, because as pension director for Boots, the pharmaceutical firm, he actually carried out a strategy of matching the firm's liabilities by investing in long-term bonds. So he's kind of a pioneer of correct thinking about pensions in the UK. I would, yeah, the example that he has in mind that Paul Samuelson wrote about in a very short essay, brilliant little essay, was to illustrate why it is that time diversification doesn't work. Because every year or every month, whatever it is, it's as if you're drawing from a raffle, if you will, a rate of return on the stock market. And if you have a long string of bad luck, you're going to lose a lot of money, and you're going to lose more in the long run than in the short run, because you can lose, let's say, 20% one year, and then the next year another 20%, and then the third year another 20%. Now, the likelihood of a long string of losses, big losses, is low. The probability is low. But that's the tail of the probability distribution. You're exposed to that. And so in terms of how bad things can get, they can get worse and worse in the long run than the short run.
That's a good example. And when you're thinking about it, you don't know what the world is going to give you. So you might be lucky, you might be unlucky, but you have to think about what happened if I'm unlucky. That's, I think, is the point. Iron Bright has a question. It says, given Professor Bodie's comments, is an appropriate approach to life cycle investing to use your 100-year age to be invested in stock? So a 40-year-old would have 60% in stock, 40% in bonds. A 60-year-old would have 40% stocks and 60% in bonds. The approach seems to fit his argument. What's your view on that, Zvi?
Well, I'm not exactly sure, and I don't want to bore your audience with too much math, but the basic point is this. If the amount you have in your retirement portfolio is increasing over time as a result of saving, and the amount of earning power you have left is decreasing over time, what you're going to see is of your total wealth, which is the sum of your let's say your retirement portfolio and the present value of your remaining earnings, okay, we call that human capital, then even if you have the same fraction of your total wealth exposed to the stock market, what will happen is the fraction of just your investment portfolio that's invested in stocks will go from, let's say, 100% in the early years down to whatever, whatever your risk tolerance says you're willing to take when you reach age 65 or 70. And at that point, it might be only 20% invested in stock.
If you follow, I think what Ian is saying that basically following a simple rule of thumb, is sort of will explain the journey you described of your sort of human capital getting less and less, and
yeah, that's right. But in my example, I'm assuming human capital is safe.
Yeah.
So it's like a bond as opposed to a stock. But there are some people whose human capital is like a stock, and then the logic gets reversed.
Yeah, and I would say a lot of people, you think of your income as a bond, but you might lose your job, you might have an accident. So it's probably way riskier than we look at it and think about it.
That's correct.
So it doesn't make life easier, but it increases some challenges. I have a long question here from Theo Kocken, which you know very well. And he says, unfortunately, most people still don't get your argument, and including academics, at least some of them here in the Netherlands, because they don't focus on the tail risk, but they focus on the standard deviation, and related things are not showing the real risk for the individual. So that was a statement. Now comes the question. Isn't this a problem of our education, that we look at risk the wrong way, using measures like value at risk and define then 2 or 3 standard deviations? And Theo says the whole CDC concept and the miracle of time diversification is based on expected return, since time minus standard deviation equals square root of time, which goes up in the longer run.
Well, ironically, I would say that the average person who knows very little about finance would be prone to think that stocks are risky, no matter how long your time horizon. So in some sense, you're better off not being educated by, let's say, actuaries who have a theory which is wrong, than being, just staying ignorant.
Let's see, I would
had the experience of talking, with relatives or friends and saying, look, no matter how long your time horizon, you got to recognize stocks are risky. And they say, yeah, of course. So they're not subject to the illusion. It takes an actuary who's going to go through a series of steps of reasoning that are misleading to, and I say actuary, but it's not just actuaries who get it wrong.
So Zvi, what you're saying, which I think is a good summary of it, is that when you don't know anything about finance, you think of risk in terms of tail events. Then when you put you through business school, you start thinking about risk in terms of standard deviation. So actually, intuition is correct, but we learn to look at risk through a lens, which is not that useful in practice. I have one anecdote from my life. I was in the board of one of the AP funds up in Sweden, and they said, we're going to show you some risk numbers. And then I said, with a bit of a joke, if you want to see a grown man cry, then show me value at risk. And I had to cry. That's what they came up with. And I can understand them. It's not, you have to do it because it's expected. And it's really difficult to think in terms of tail risk, but it is the intuitive thing to do.
Yes, yeah, exactly. So, as so often happens, this happens very often in medicine or nutrition, where there are theories that, when you're ignorant, you wouldn't think of them. And the theories turn out to be wrong. So experts who believe in that theory do more harm than good.
Yeah. So the power of knowledge versus intuition, sometimes you over-engineer things instead of making them understandable. I have a question from Richard Fulmer. He says, hi, Zvi, great to see you. What do you think about transferring risk to an insurer in the same way you do with annuities, rather than investing in safe assets? Or surely the answer will depend on how much of a DB pension you might have. But he would be interested in your thoughts in general on this.
Yes, well, Richard Fulmer, actually, he and I have an article together that we wrote a while back. I think the title was Unsafe at Any Speed. And we were making an analogy with automobile insurance when it comes to pensions. And Richard is a real original thinker with regard to dealing with the risk of outliving your retirement income. My sense of it is whatever works. First of all, we have to have the correct science. Okay, we have to know the true nature of the risk and make sure that the experts get it right. The problem with insurance, as opposed to, say, government guarantees, is that there's default risk of the insurer. And it's not an easy proposition to make private insurance be 100% safe or close to 100% safe. As we saw in the great financial crisis of 2008-9 was caused by securities which were supposed to be AAA, in other words, as safe as government bonds, that turned out to be risky. And that undermined confidence in the whole system.
Yeah, people thought they had a bond, but realized they were owning a stock at the end.
Yeah, or worse.
Yeah. Dirk Broders has a question. He says, great to see you. The Netherlands, he met you more than 10 years ago in Netherlands, where Netherlands trying to move from a DB system to a system with DC features. He says that this transition seems to be held back by vested interest and political influence. What is your advice to Netherlands?
Oh, well, my advice is to listen to Dirk Bruders. Dirk gets it. He was present at the very first seminar that I gave and immediately understood the right way to think about risk in the long run and equities and everything else. So there is a challenge of getting the experts to see things the right way. And in the Netherlands, that has proven to be harder than I thought. You know, when I love visiting the Netherlands, I haven't been back for several years because you take economics very seriously as a people. Economics is given a lot of respect in the Netherlands. But there are people of great influence who don't get it. For example, I don't understand why in the Netherlands the government has been reluctant to issue inflation-protected securities, and because they really are needed as the basis for long-term pensions. Now, you have substitutes in the Netherlands in the form of inflation-linked bonds issued by other governments, other European governments, but I just don't understand why the Dutch government doesn't issue inflation-linked bonds.
And some good news, Zvi, is that over the years, Netherlands have done a lot of discussion on this, and they moved into new pension contracts. So they are slowly making progress in a good way, and they also are moving to a DC kind of system where more of the risk is borne by the members. So I think over time, it's moving in the right direction. But then it's also important that you get sort of the security you were talking about in terms of your income. Here's another question from Keith Ambaxt here. He says, Zvi, inflation-linked bond yielded 4% when they were issued. Today, they yield 0. Does that sort of difference impact your investment policy at all? Do you think that differences impact equity prices? Do you think equity prices are predictable to any degree? Do you think the return distribution of equities are predictable to any degree? That was a lot of questions in one, but trying to pick the spirit of it.
Right. Keith and I have discussed this issue, and I think we disagree basically on the risk of equities, and probably disagree about the risk premium on equities as well. Look, were retirees better off, or savers and retirees better off, when the yield on inflation-protected bonds was 3.5 or 4%? Yes, to the extent that they rely on fixed income investments. But even if they're investing in stocks, if you think that the risk premium is constant, then, in other words, the differential between the expected return on stocks and inflation-protected government bonds, then if the interest rate on inflation-protected bonds goes down, the expected return on stocks has gone down as well, if that differential is constant. And I don't know, I happen to think that stocks right now as an asset class are relatively overvalued, but there could be there's tremendous disagreement among so-called experts with regard to the rate of return on the stock market. Just this morning, I was reading how one of the big investment firms thinks there's no risk premium on a diversified portfolio of stocks right now. you know, I have my own view, which is that there is a positive risk premium on stocks, but not very high. Keith, I think, is more optimistic about the stock market.
Thank you, Zvi. And I have another question from Dan Cassidy. He says, hi, Zvi. Pension obligation bonds have recently had a resurged. Can you comment on these POBs to support public pension plans in the US? What can financial economists do to combat this trend? Question mark.
Yeah, so here's the absurdity of this. If you believe that stocks offer a positive risk premium, yet are not risky in the long run, and you are let's say in charge of a state pension fund in the United States or anywhere for that matter, which is underfunded, and so you're desperate for a higher rate of return, what you might do, if you believe in the fallacy that the risk on equities goes away in the long run, is issue bonds at a fixed interest rate and invest that money. You use the proceeds to invest in the pension fund and invest in stocks. So what you've now done is created this very risky portfolio funded by debt, and you're investing it in the stock market, and the justification is this belief that in the long run, stocks are almost certain to outperform bonds. That's a very, very risky situation. And who's taking the risk? The taxpayers of the state that is sponsoring this pension fund.
But you can say, Zvi, with a bit, I'm saying this with a bit of a smile, is that, well, they are civil servants, so they should really take risk in the pension investing, and they really do, because they lever it up.
Well, it isn't necessarily the pensioners that are taking the risk. It's the taxpayers, because if the taxpayers have to pay, you know, a state government in the United States cannot declare bankruptcy. Cities can. In fact, the city of Detroit declared bankruptcy as a result of not being able to pay pensions. But a state government can't do that.
There's a question for Bernard, from Bernard Casey as well. And it says, can we use Black-Scholes to show us the real cost of long-term put options, where the long-term is the long-term you talk about?
Sure, but you know, there are more sophisticated models than simple Black-Scholes. There are pretty, you know, good models that can do that. Of course, in saying that, I'm disagreeing with none other than Warren Buffett, who has repeatedly said in his annual report to shareholders of his funds, the Berkshire Hathaway fund, that he doesn't believe that the option pricing model, whether it's Black-Scholes or some variant of Black-Scholes, applies in the long run. But let me point out that Warren Buffett is not an economic theorist. He's a talented stock picker.
Thank you, Zvi. And another question here, by the way, is from Marlene Kallestrup-Lamb. It says, hi, Zvi. Could systematic longevity risk affect the way we think about asset allocation throughout the life cycle? Should retired individuals get more risky in order to ensure future consumption?
Well, there's a contradiction right there in that last statement, okay? Should they take more risk in order to guarantee consumption, you take more risk, the guarantee becomes riskier too. And you've got to, that has to be reflected in the price of the guarantee. So if, you know, if I have a safe investment portfolio underlying my future consumption, then if I wanted to buy a guarantee against market risk, it'd be relatively cheap. But if I'm investing, I don't know, 100% in equities, that guarantee is going to cost me a lot more.
So yeah, I think what Marlene was referring to was that if you thought you would live and have 20 years in retirement, all of a sudden you're living longer and going to have 30 years to get
I understand, but no matter how long you live, if the risk is not related, is not in the usual sense related to longevity, you know,
it doesn't matter.
It doesn't matter. It's a separate issue. The way you deal with longevity risk is through annuities and the pooling of mortality risk. That I recommend to any group or pension fund or whatever. If you pool risk, you reduce the risk exposure of the members of the pool.
Yeah, you never know how long you're going to live. And if you die, well, wherever you're going, you're not going to bring the money with you. So it's probably a good thing to have it in case you're lucky and living long.
There are two objections that people have to entering into, let's say, an annuity pool. And that is, they want to leave something for their progeny, for their children. And if you pool your retirement wealth, then you give up anything that's left over after you die. So there's that.
Yeah.
And the second is fear that of default, that, you know, they'll enter into the pool and it'll be mismanaged or invested in risky assets, and that there'll be nothing there for them.
So Zvi, let's turn the roles around. We have asked you a lot of questions. Now it's time for you to ask a question. And the person you're going to ask the question is Keith Ambachs here. And I know he's on this call because he asked you a question. So for the next webinar, we're going to meet with Keith Ambachs here, and that's on January 6, 2022. And Zvi, what is the question you would like to ask Keith?
Well, I've discussed some of these issues with Keith, just the two of us. So I'll now make public what I think is a point of disagreement and ask him to justify his position, which is he's in favor of a particular style of Canadian pension fund. And his belief is that they can beat the market, that they can outperform in their investment management the average performance of pension assets or assets in general. And my question to him is, why does he believe that? I mean, because there's so much evidence that even the professionals, with very few exceptions, if any, can beat a passive investment strategy. And Keith seems to be defending their ability to pursue an active strategy that's going to outperform passive. So what's the justification for that?
Thank you, Zvi. And now I think, Keith, you have something to think about over Christmas, and we can hear your answer when we're back. I would like to thank you very much, Zvi, for being here and sharing these discussions with you. It's a really important topic to understand time diversification and the implications of it. And,
well, thank you, Stefan.
And I will thank everyone who's been here and enjoying the webinar. And despite we had some technical issues, I had a great time and I hope you have it too. So looking forward to see you the next time. And thanks again, Zvi.